Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to talk about the UK ISA, the stocks and shares ISA, versus the SIPP, the self-invested personal pension. A lot of people this time of year, especially when we're right in the end of the tax season, April 5th is the end of the UK tax season. We're coming in to that now. So a lot of people are looking at it, seeing what spare cash they have around and trying to decide which one to invest their money into. I know I was there. A lot of times I was confused. Should I put more on the ISA? Should I put more in my SIPP? Well, that's the topic of today's video. We'll break them both down. I've got a nice table produced for this. Try and make it as simple as possible. And at the end of the video, I'll give you my thoughts on what you should do depending on what your goals are, and a couple of other things to think about that I've learned over my 20 years saving and investing and watching other clients do this themselves. Okay, so let's get into the video. ISAs versus SIPPs. Okay, so for the purposes of this video, we're not going to talk about cash ISAs. I did do a video recently on cash ISAs versus stocks and shares ISAs. Highly encourage you to watch that. Stay away from cash ISAs, in my opinion, for anything that you might need the funds more than 5 years time from now. But I'll put a link in the description to that recent video so you can get up to speed if you need to. But for the purposes of this video, stocks and shares ISAs only is what we'll be talking about, and SIPPs, of course. Okay, so if you look on the screen here, I've got a chart where I break down kind of the features between the stocks and shares ISA and the SIPP, the self-invested personal pension. Okay, so we'll take it down kind of line by line and break it down. Well, first of all, when it comes to the contribution limits, for a stocks and shares ISA, you're allowed to contribute up to £20,000 annually. And annually, of course, is based on the tax year, which starts on April 6th every year and ends on April 5th. So the deadline is fast approaching. If you don't use it, if you do not put the full 20,000 in, you can't carry it over to next year or anything like that. You'll actually use it. However, with the self-invested personal pension, you can put up to £60,000 annually into your self-invested personal pension. Now that depends on your income. In other words, you cannot put more than what you earn in a given year. So if your annual salary is £40,000, well then you could only put in up to £40,000 in your SIPP. You couldn't go with the full 60. But of course, if you earn 60 or more, you could actually put the full amount into your SIPP. So it has a much higher contribution limit, particularly good if you earn a lot more money, obviously. What about the taxation? Okay, well, the first thing to say is both of these accounts will allow for tax-free growth of your investments. That's tax-free on capital gains, dividends, and any interest. So there's no difference as far as that goes. They can all grow tax-free. Okay. Now, with the stocks and shares ISA, you don't get any sort of tax relief. So any money that you're putting into an ISA account would be after-tax money. The government has already taken the tax off of it. So it's going from your bank account into your stocks and shares ISA, and you will not get any tax back on that. Now with the SIPP, you actually do get tax relief, and I think this is one of the main benefits of a SIPP account. So if you take out your debit card, for example, or just do a bank transfer into your self-invested personal pension, in the government's view, that money that you put into your SIPP has already been taxed. They've already taken the tax off. But because they want to incentivize people to save for their retirement, they're willing to give you that tax back, known as tax relief. So another thing to be aware of when it comes to SIPPs, besides the upfront tax relief that we just discussed, which is a huge benefit, you will have to pay some tax on withdrawals when you start drawing down your pension at age 55 or 57. As it stands right now, you can take out 25% from your SIPP and not pay any tax whatsoever on it. But after that, you'll pay tax at your normal income rate at the time. Now, the benefit is at that point, you're going to be retired. So in theory, you don't have any other income. So if you're paying 40% tax now, for example, based on your current salary, later on in life, when you're time to withdraw this down, you're probably going to be in a 20% tax rate. In fact, if you take out £50,000 in a year, well, as things stand, your first $12,500 will be tax-free, and then the remainder up to $50,000 will be taxed at only 20%. So therefore, there's still a huge benefit in taking money out of a SIPP at that age at the lower tax rate than you may be doing now. So how does that work? Well, there's a really simple example here. Let's just assume you took £100 out of your account and you put it into your SIPP account. The government will actually mark that up by a factor of 20% because that is the basic rate tax payable in the UK. So the math actually works where they want to do it on a gross basis. So if you take £100 divided by 0.8, that will get you £125, and that is the amount that will actually hit your SIPP. 100 from you, and then 25 will be claimed back from your broker, from the government, and will go into your account several weeks later. So your gross contribution is actually £125 in that example. Now, of course, if you put more in, imagine if you put in £1,000, well, then you're going to get £250 added into your SIPP by the government because you've already paid tax on that and they want to give it back. But what if you're a higher earner and you actually pay 40% tax on your income? Well, in that case, not only do you get the 20% added on to be grossed up, but also you can claim back the other 20% from HMRC at the end of the tax year. And they will actually recalculate your taxes based on everything that you paid or received over the year for your tax, and they will rebate you back the additional 20%. Okay, so this is a very huge benefit when it comes to contributing money into a SIPP and can actually really help supercharge your returns because you're going to get the tax back on the money that you put into your SIPP. So it's very, very helpful in growing your wealth. Okay, what about the investment options when it comes to a stocks and shares ISA versus a SIPP? Well, when it comes to the ISA, you can really only do cash products. And by cash products, I mean things like stocks, bonds, funds. And by funds, that could be exchange traded funds, index funds, mutual funds. You can do all of that in there, which is basically everything that you need for growing your wealth over the long term. Okay. One thing to bear in mind when it comes to ISAs, you can only have them in GBP as a base currency. And that's fine for the majority of people, but you could not open up a US dollar account, for example, as an ISA. They have to be in GBP. So therefore, if you were planning to buy, say, US or European shares or ETFs, then every time that you do so, there will be a currency conversion. Your funds will convert from GBP over to dollars or over to euros. Just be mindful of that. If you're active trading, for example, which you shouldn't really be in these accounts, then a currency conversion fee could add up quite a lot and eat into your return. So be aware of that. A lot of people don't realize that's the case. Now on the SIPP, you can do all of those cash products that you can do in the stocks and shares ISA, but you can do other things as well, like stock options, commercial property, or even alternative investments, things like private equity and things like that, where it's allowed to do so. Not all brokers allow this, but generally speaking, the range of products is larger. Also, if you do have a SIPP, if your broker allows it, you can open up a US dollar or euro account if you're planning to have your investments in the US or in Europe as well. And that will save you on currency conversion fees for your purchases. So overall, the SIPP will allow you to do more type of investing. But what about when it's time to make withdrawals? And this is where things really start to differ here between an ISA and the SIPP. With the stocks and shares ISA, you can access your funds anytime you want, no problem at all. Just sell, make a withdrawal from your brokerage account and it'll go back into your bank account. No penalties or anything. And a lot of people prefer to do the ISA for this reason. They love to have that safety and comfort knowing they can access their money anytime. But when it comes to investing in a SIPP, any money that you put in is locked in until the age of 55. And that will increase to 57 in 2028. So this is a long-term, primarily retirement-driven savings account. You cannot get this money no matter what before the age of 55, again going to 57 and 28. And this puts a lot of people off. From my experience, what I've seen, a lot of people are reluctant to put money into their SIPP because they're afraid they're going to need the money at some point and won't be able to touch it at 55. Okay, so ultimately you can kind of see what the purpose of these accounts are. With the stocks and shares ISA, it's really about flexible savings and investments. Thinking maybe 5 to 10 years, perhaps earlier if you think you would need the money sooner than that. And when it comes to a SIPP, well, it's really primarily a retirement savings vehicle. So which one should you choose? Well, if you really want to prioritize flexibility, then of course the ISA is easier because you can access your funds anytime. But if you're trying to prioritize your retirement savings, long-term investing for that goal, then the SIPP is the better way to go. But there's a couple of other things you should really be aware of. And I want to pass off some of the knowledge I've seen in both my own experience and clients that I've seen kind of trying to wrestle with this and decide what to do between their ISA or their SIPP. First of all, before doing either of these, you should have an emergency fund built up. Something like 6 to 12 months put away just in a normal savings account in case you lost your job or something really, really difficult came about and you needed that money. So just bear that in mind, do that first. Okay, so a couple of other things to keep in mind. In my opinion, I think you should prioritize the SIPP, especially if you're a 40% taxpayer, because you're able to get all of that tax back, not just the 20% basic rate, but you'll get the additional 20% back as well. But if you're on a lower income, that doesn't mean you shouldn't do a SIPP either, because the government will top it up with the extra 20%. So like I said earlier, this can be a way to help you to supercharge your savings and investment for your plan for the long term. Okay, another thing that I see that you need to be aware of in your thinking on this. A lot of people are very reluctant to add money to their SIPP because it's going to be locked in till they're 55 or 57 years old, and they're afraid to do it. But there's a huge advantage in this. The huge advantage is it forces you to think like a long-term investor. Your mindset is completely different when the money's locked away for that length of time. I've seen so many people go into stocks and shares ISAs because they like that flexibility. But guess what? They can sell, they can take the money out at any time. And that makes the emotions of a stock market sell-off or just some needs of the money take priority, and your behavior tends to be a lot different. I see people being far more active in an ISA than they are in a SIPP. And therefore, the returns generally from a SIPP are going to be better because you're going to behave with a long-term investing mindset. ISAs just tend to lead to more short-term trading behavior, which in all honesty produces lower results. But if you think you can control that and you want to do the ISA, then go for it. But just be aware of that. Another way to look at this, if you're unsure which one to do a little bit of both. I think you should prioritize your retirement savings first. But what if your goal is to retire earlier than 55 or 57? You might have a goal of retiring at 50, for example. Well, in that case, what you can do is you can use a stocks and shares ISA to bridge you through to your SIPP. So you can make your SIPP your primary retirement vehicle, but also have a stocks and shares ISA and contribute to that with the view of maybe drawing that down at 50 years old, 52 or 55, for example, and have enough in there to hold you over till you get to 57 where you can start withdrawing from your SIPP. So if you thought you wanted to retire at 50 and that was your main goal, then yeah, you want to have both and just make sure that you have enough in there to cover you through to 57. In that case, you would need around 7 years living expenses. Draw down the ISA, and then you turn 57, you can access your SIPP. So basically, in my opinion, I think the SIPP is the one you should prioritize because it forces you to think like a long-term investor and will get you better results. Plus, you get all those amazing tax advantages. The main thing is you're actually getting investing here. Do not let the over-analysis get in the way. It's one of the worst things about the whole finance industry. There's so much knowledge and jargon and everything. It leads people to inaction. The main thing is that you're actually investing for your future. That is the main takeaway you want to have from this. Just get invested and get it going. Well, that's my video on ISA accounts versus SIPPs, trying to work out which one is right for you. If you like the video, why not click on the like button? If you haven't done so already, subscribe to my channel so you'll get more good videos like this that hopefully helps you and inspires you to save more for your future. Also, if you're worried about stock market volatility, because there's a lot of that going on at the moment, well, I did a video recently on how to handle a stock market crash. Put this video right here. So just click on that link right there. I'll see you over there in that video. And as always, I wish you nothing but the best in your savings and investment journey.